How's it going out there? It's January 17th. I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break the headlines and tell you what's really moving these markets. So I was at a mall last night, get some things for my house. Actually went to a couple of furniture stores located in one of the biggest mall areas where all the stores are, in Jacksonville. It wasn't that crowded, I guess, as expected. You have people relaxing after the holidays, take a little bit of break after spending money and stuff like that. But I have to tell you, I don't think I've ever seen this before. Because some of the stores that I went into with my kids, they had very little inventory on the shelves. And everyone's been critical, including us, of inventory, right? Inventory levels are so high, you got to get inventory levels low. But there's nothing on the shelves for us to buy, right? So when we're going in there, I was just surprised to see very little, especially clothing and stuff like that and different things. And you know, it makes you think how difficult of a job these retailers have, especially in some industries, right? Seeing the auto industry retail get annihilated right now. So many, just used car sales coming down. Seeing retail in general not participating too much in this rally. The Bed Bath & Beyonds we're just seeing a lot of companies close shops, lay off, announce second rounds of layoffs. We see the market going up a little bit this year, but still in retail, you're critical if they have too much inventory because of the way the market is. You have to be very careful, right? You're seeing demand come down tremendously. You're seeing people's wallets and the amount of money they have in the bank shrink. I'll talk about that a little bit more later on. So with demand coming down, you want to make sure that inventory level comes down sharply because otherwise you got to sell it at a significant discount, which crushes earnings. However, you do want to have some kind of inventory there for people who do want to go shopping. You're just seeing these stores. I want to hear from you guys, frankcurzioresearch.com, if you're seeing the same thing. But I've seen this in probably about 10 different stores I've shopped after the holidays and pretty much in January. And usually you can go there, you can get some of the stuff that they'll have discounts or those secondary discounts after Black Friday and after just before the holidays or whatever. I mean, they don't even have product on the shelves in some of these stores. I'm talking about the Best Buys. I'm talking about different clothing retail stores. I'm talking about Dick's Sporting Goods. Very little clothes that they had there. I was surprised in sizes. Again, I'm in XL. I'm not like a super crazy size. But even large and stuff like that. Just there wasn't a lot of inventory, which I was very surprised at. But what I did notice is, and I don't know if you're seeing this in the neighborhoods, and I've just been in Florida for so long, but you see more people on the side of the roads and with signs up and asking for money and things like that. And I've always felt bad about that, but always felt, maybe the wrong way about it. Like, if you want to get a job, you can get a job. And I try to see that, explain it to my daughter too, because they feel bad. I'm like, it's just something I would make sure that, for me personally, would never happen to me, because I would make sure that I'll work for free someplace and get a job and just, bust my ass because I can control how hard I work, right? And anyone that does that, you always be successful, I think. Even if you feel like that might not be the industry, you'll be successful on that journey. You'll understand work ethic and understand how to be successful, right? Because you'll be around really good people and you're working your ass off. Again, the one thing you can control when it comes to jobs and everything, and someone can lay you off, you may be a good employee. I've been laid off when I was, generating a ton of sales for my company, one of the leading sales generators for the companies. It's just when they cut back, you don't know. They have control over you. But what you can control is how hard you work. I've always said that. And just to see some of these people on the side of the road now, seeing them a little bit more, just curious if you've seen them. But anyway, me and my wife were going to my house, and there was a guy across the street, and he had a big sign, money for food, and he had a cane. And he was walking across the street with one of these canes, and holding up the sign and trying to hold the cane at the same time. But this week, it was like the 40s in Jacksonville. I mean, it was really, really cold. I don't know if you saw the Jacksonville game. Great job by the Jags. Amazing, amazing comeback. But it was below 40 that game, which is very, very cold here. It's usually warmer, which is, I thought it hit the under, right? Two hot weather teams with San Diego. But what a game that was. And it was great. But it was really cold and very windy, like 20, 25 mile an hour wind. This guy was walking across. All of a sudden, his sign blew away. It blew out of his hands. And there's a parking lot behind him. And me and my wife were looking at him because we're at this light. And all of a sudden, I felt bad with the cane and the sign. But to see that sign come out of his hand and fly in the parking lot. And again, with that cane, the guy went after the sign. Now, I'm not saying he would have beat Carl Lewis in a race, but it would have been close. That's how fast he ran to get this sign. And I've seen a lot of that in New York too, right? Where it's just like, you want to feel bad, and you do feel bad sometimes when people do need help. But other times it's just seeing that. But that was a story. It was like, I couldn't believe as soon as that sign went off, that guy, it's like, man, that guy, it was like a miracle. The guy, seriously, one of the fastest older people I've ever seen in my life. That's how fast. And he got the sign like just halfway across the parking lot. It was great. But I am starting to see that. I am starting to see that on the side of the road, which I don't really see in Jacksonville. I always saw that in New York City growing up, especially in the 80s and the 90s and stuff like that. But, people are starting to struggle. I mean, that's the bigger trend here. It's going to get a lot worse before it gets better, no matter how much we see these mini rallies out of stocks. And we're seeing stocks go higher right now, and now earnings season's really officially, you could say whenever it started, but now it's the heart. In the next couple of weeks, you're going to see tons of companies reporting. If you own any of our newsletters, subscriptions to our newsletters, this is where, especially Daniel, finally gets off his ass and works his ass off and starts reporting a lot. Just earnings and giving updates and everything, right? Because I love earnings season. They give real-time updates. Goldman Sachs reported, and this is coming off of JP Morgan, which wasn't that pretty, but Goldman Sachs missed by a mile. The largest miss in over a decade. Okay, looked it up. I've never seen them miss by that much. They usually, they're always beating by like a ton. Trading revenue and all this stuff. And Morgan Stanley was good. It wasn't great. It was mostly in line, a little bit of a beat, but it just made the Goldman Sachs numbers look so much more terrible. And it was interesting because it's a trend that I told you about probably 6 months ago. I said, we're in a market where we're not going to see everything where it's a bull market, everything goes higher. Just like a bear market, everything goes lower. We're in a market where management teams matter, earnings matter, operations matter, right? Because it's going to be hard to grow top line. It's going to be hard to even grow bottom line. You got to cut costs and things like that. So management teams are critical. But this is going to be the first time you see in probably 12 years where there's going to be companies within a sector that do well and others not do well. Where we've always seen, listen, you see Salesforce.com go up a lot higher than some other, software companies, but they'd all really go up. But now you've seen today, in general, right now, Goldman Sachs is down 6%, doing this midday, is down 6%, while Morgan Stanley is up 7%. They both reported today, right? So you're seeing the separation within industry leaders, 1 and 2. And you'll see Home Depot and Lowe's and Target and Walmart, but a lot of times you'll see, 3-4%. You don't see a move like this in the same day that they report. Like, it's very rare to see something like that far, that wide of a gap, that kind of discrepancy. But it just shows you, Morgan Stanley was okay, but Goldman Sachs, looking through the quarter, it was bad even though they laid off 6% of their workforce. Now, I'm going to get to a very important point here you need to understand. Because what they said is 2023 looks uncertain. Uncertainty is the death of stocks. I tell you that all the time. When you're uncertain, you don't know whether to buy, you don't know what's going on. That's why we're trying to figure out how far the Fed's going to raise, how far they're going to go. And we still don't know, because if the market holds up like this and we continue to see this rally, they're going to go into the summer and continue to raise, because the Fed doesn't want to see this. They want to see the market really, really pull back. We're seeing inflation trend in the right direction, but it's not down tremendously off its highs, right? It's trending in the right direction. It's still very, very high. I mean, the bills you're not noticing outside of gasoline that you're like, holy shit, man, my bills are so much lower now. Gasoline you're noticing, but you're not noticing anything else. Food, electricity, a lot of other things that you pay for. Insurance, house insurance, auto insurance, and things like that, you're not noticing. Right? You're not seeing it to the point you're like, wow, this is great. Inflation's coming down. I feel better. No, you're still not seeing it. It's still very high. But they said underwriting is extremely muted and seeing early signs of credit deteriorations. That's very, very important, and you need to understand that. Because if you're seeing credit deterioration now, what do you think it's going to look like over the next 6 to 12 months? We have the Fed is going to continue to raise rates at least through March, but if the market does hold up here, they're going to keep going. They're going to keep raising. They're not going to stop raising and watch the market go up 15, 20% if they stop. They're not going to see that. No way. It's the last thing that they want. They made that very clear. We do not want to be early on this. We don't want to stop early. And they're not. Which means for those of you who think that, the pausing, fine, you have an argument. It could be March, April, May, June, July, and go a little further, maybe into the fall, who knows. For people saying that the Fed's going to cut rates this year, they're out of their mind, unless we see a dramatic collapse in the markets. It's not going to happen. It's not going to happen. So it means rates are going to remain relatively high. And also you throw in QT, quantitative tightening, where the Fed's shrinking its balance sheet by hundreds of billions of dollars every quarter, removing money, which means market conditions are going to continue to deteriorate. Demand, you're going to continue to see that destruction. So, like I said, while inflation remains pretty elevated for most families and their bills are still high, yeah, it's tough to see, even with inflation moderating, that we're going to go back and say the Fed's going to be like, oh, okay, well, we're done. Okay, we're good. Don't worry about QT. We're not shrinking our balance sheet anymore, which they said they're going to shrink probably for the next 18 months. I mean, they have to take that money off of their balance sheet. And then you're looking at rates going to stay relatively high. And yeah, they're pulling back a little bit and you're seeing mortgage rates fall, but they're much, 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 much higher. You're not seeing the housing market take off because mortgage rates went from 7% to wherever they are, 5.8, 5.9, around there. You're not seeing, oh my God, well, demand's coming back to the market. No, they were below 3% in January. So the housing market, I mean, you want to talk about frozen. Holy cow. And even in Florida, and Florida's supposed to be a great market, right? I live here. I own 3 houses here, but I'm trying to sell one of them right now and having trouble selling it. I mean, not even like an offer. And again, it's January. It's not the, you go into late February, March, April. That's great for Florida. You see houses really fly, off the shelves here. But we'll see. But right now, usually it didn't matter. It was a couple of weeks. It's been on the market probably for 3 weeks. I haven't gotten an offer. And it's in line with everything. I'm not trying to get, again, not even a low ball offer. No matter what the price is, someone's not coming in much, much lower, which I'm surprised. But you're seeing it. You're seeing everywhere. And I'm hearing that from real estate agents that, it's going to deteriorate even more. It's going to get worse before it gets better. Now, when I look at Morgan Stanley numbers, a little bit better. Again, I talked about that separation we're seeing within industries for the first time in a decade. Like, I can't believe I'm seeing Goldman Sachs down 6%, Morgan Stanley up 7% the same day when they reported. That's pretty cool. But Morgan Stanley, I don't know. I may look to sell here. I mean, they're up, but they even said they expect net interest income to moderate from the pace of the last 2 quarters. So they're predicting slower growth going forward, along with most of the banks. Now, with banks, and people want to buy banks, and I made the mistake earlier, and we got out of them, which was good. But interest rates rising is supposed to be very, very good for banks, right? Because their net interest margins expand. What they able to lend the money for, again, that margin expands. That's great. That's how banks used to operate forever until about 12 years ago, because we pushed rates to 0. So banks are like, holy shit, we got to find other ways to make money. What do? They had fees everywhere, right? You shook the hand, you waved, and it was a fee at a bank, right? Everybody got fees. But just the investment banking fees have taken off, the trading fees. The fixed income fees are always going to take off because it's an illiquid market, and they use that to their advantage, these banks and investment banks, in terms of trading. But they ramped up their fee-based businesses, their advisory businesses, and there's so many business deals going on. It was crazy, right? They're making a fortune. So while higher rates are good for banks, it crushes everything else they made money on, including advisory fees, those investment banking fees, overall banking fees for the past decade. But more importantly, if you're looking at the banks and what's going on right now, what are they doing? They're ramping up their provisions for credit losses. So they're preparing for potential loan defaults. That's one story in itself. Okay, and some people may say, well, they're being conservative. The banks are being conservative, right? They're just making sure, right? Based on new laws and Dodd-Frank, they're being conservative. This stuff is based on algos. It's based on AI, which tries to take out the guessing. So once things hit and they see certain factors happening, the computer systems are saying, ramp this shit up because we're expecting tougher times. Based on everything we know, putting in all the data points for the last 50 years, 60 years, this is what we know what happens. So it's their algorithms that are telling you. This isn't a guessing game. They're trying to take as much guessing out of it by using AI and using algorithms, right? So they're algorithms. That's why you're seeing all these banks increase these provisions for credit losses. Now, S&P 500 banks reduced their provisions for loan losses significantly in 2021. Remember, 2020, the market did great in 2020. We just had like a month and a half before the Fed said, balls to the wall, 11 trillion, 50% of GDP out there. We're just giving money to everyone. I don't care. Even when the market comes back, we're still giving trillions and trillions and trillions. I always say, to put that in perspective, when you look back at TARP, that would turn out to be $470 billion to save the whole world from a credit crisis, right? The whole world from a credit crisis cost $470 billion. We're throwing trillions around like nothing, right? It's up to $11.5 trillion just in the U.S. That's just the U.S., right? Well over $20 trillion when you look globally. How much money's been injected that's now coming out of this market? But 2021, banks knew, hey, we're seeing great numbers. The algorithms are showing that loan losses are the lowest they've ever been because everybody has money and free checks. Again, this wasn't given to the banks to bypass. The banks got the chance to lend out the money, right? There's like to shore up the banks. Now you bypass everything. You hand the checks directly to businesses and PPP loans to people directly. You have a couple kids. Here's a couple more $1,000 here, there. Everybody has money, right? Everybody's rich, right? Your next door neighbor who held a job for 6 months has like 2 Mercedes in their driveways now, right? That's 2021. So they reduced their provisions to the tune of $27 billion. Now, that's very, very important for you to understand because in 2022, last year, fourth quarter is being reported right now, they've increased these provisions so far, right? 2022, and this is accounting for the estimates in the banks that are already reported, so it's going to be pretty close to this number. They're increasing their provisions by $17 billion in 2022. And this number is likely to go a lot higher in 2023. Now, why is this important? Why am I saying loan loss provisions on a podcast? I mean, you're going to go to sleep, you're going to change the channel, you're going to put something else on. It's important if you want to make money in stocks, which I think you care about is why you listen to this podcast. Okay, provisions, those provisions, they don't impact the top line, which is called the revenue. That's the top line, the revenue and the sales. It destroys the bottom line. And so much so that banks are expected to report this quarter, and it might be lower than this after Goldman Sachs just reported. They're expected to report a 26% decline in earnings year over year. So for this quarter, and you compare it to last year's fourth quarter, a 26% decline in earnings. You know how much that is? A 26% decline in earnings? I mean, that is massive. It's massive. So you're looking at decline in earnings per share. So when you see banks coming down 20, 25% from their highs, you can't go in and say, wow, I think banks are cheap here. Because they're not. Why? Because their earnings are absolutely crashing here. They're revising their models that were fee-based into more net interest income. And you could see it in their results. They're making a fortune. They're making so much money on the net interest margins. But when you're losing all that business that you got from mergers and acquisitions and even trading, which is a little bit less trading now, right? So you're not seeing as much liquidity now with the markets down as much. You're just, again, that merger acquisition, advisory fees, you're seeing the fee business absolutely crash here. And that's what's hurting these guys. But not only that, they're seeing their provisions, those loan loss provisions, go higher and higher and higher. And as they do that, that comes directly from the bottom line. So when you're looking at banks and their earnings declining 25%, you can't say, well, these things are really cheap here because their earnings are crashing alongside it. And I try to explain this to you because I try to educate as much as I can. But a stock can go up 100%. You might think you missed it, but it may be cheaper after it went up 100% because earnings exploded higher. But a stock can also be more expensive after it declines 30% if earnings are crashing like they are with the banks, right? It's clearly the case with the banks right here, especially with Goldman Sachs, who never misses. Goldman Sachs, we had that in the portfolio forever. I forgot what the percentage. We did very well on it. We had it for a long time. We're up a lot more, and it came down a little bit. But still, we locked in really, really good gains for Goldman Sachs. They rarely miss. Okay, just the trading fees and everything, low interest rates, they're the best of the best, right? So we all hate them, but we all kind of want to work for them because we can make a lot of money working for them. But they reported their biggest miss in earnings. They missed by the most they missed in over a decade. And I'm not sure how it's going to get better. With provisions for loan losses, they're going to increase for these banks significantly. Why? Because the markets and the conditions are deteriorating. And while many of their growth engines, you look at their growth engines, underwriting, advisory, trading, they're going to continue to be out of favor for at least the next 2 to 3 quarters at least. So be careful buying the banks here. It's not like, wow, good time to buy Goldman Sachs. It's down. Listen, I've owned Goldman Sachs for a very long time in our portfolio. And we don't own it anymore. But I can't see owning it even now, even on this pullback, or Morgan Stanley, who basically warned that, hey, the next quarter is going to be a lot worse than the previous two. It just, when you compare it to Goldman Sachs, it looks that much better. It's probably why it's up 7%. So you might be better off buying puts on that or stuff like that, maybe, over the next couple of quarters. But man, when I'm looking at these numbers, it's insane. It's just insane. When you see the headwinds, when you see what's going on with the Fed, when you see that it's going to continue, you're going to see demand destruction constantly, money shrink in people's bank accounts. You're going to continue to see that as conditions get worse. I can't see you owning the banks here. It just doesn't make sense, especially while their earnings are absolutely crashing and those loan loss provisions are going to go up a lot more next year, much more. Again, they lowered them by $27 billion in 2021. They're going to be up $17 billion. Do you think they're going to go much higher from here? I think they could be $25 billion next year. If they are, it's going to be hard for these companies to beat earnings. It crushes their earnings when they raise these provisions. It comes directly from the bottom line. Something you need to note about when they're going into earnings. It's going to be very difficult for banks to beat earnings if they continue to increase those loan loss provisions, which they were doing, and it's why Bank of America missed. I think you had one of the Bank of America was okay. I think JP Morgan missed, but you're seeing companies that the JP Morgans and Goldman Sachs almost never miss, and you're seeing them miss. And this is a big reason why, and that is not going to change going forward. I don't know if I beat that to death or not, but that's a big story here, right? That and Davos and what's going on. I just, again, caught a couple of stories of Davos. One of the ones with TikTok I thought was amazing, where one of the guys who got on, I don't know his ties to it, but apparently he has big ties to TikTok. And they were like, well, what about, the privacy issues and states, just, banning TikTok? He goes, basically, it's 100% bullshit. He goes, we're all on he said I forgot what he said, the cloud. He goes, the Safe Cloud or whatever it was for Oracle. So it's 100% on Oracle. He's like, everything is on Oracle. You could see it. He's like, there's just misinformation out there, which is what we read, right? China's stealing all the data, they're stealing everything. But yet there's a massive lobbying thing, especially probably by Facebook, because Facebook, TikTok's been destroying all these social media companies. So there's lobbying efforts going on to, hey, if you could ban TikTok, please ban TikTok. Do everything you can because it's eating everybody's lunch. It's much, much better service than everything out there in social media. I think they said they have 90 million daily users, 90 million. I wonder how much time they spend on the platform. Holy shit. Because the platform is really great. Once you go on it, you're done. It's just going to feed you everything you like really, really quick. And you could just, scroll through videos. It's not like YouTube where you're picking the video to watch. It gives you everything and then just learns from you and says, okay, this is what they want and gives it to you no matter what you are. Conservative, if you're, just leftist, if, you like sports, if you like golf, it's got all these tips. It's got, if you like to cook food, cleaning house, anything possible in these short videos that are very exciting. But I found that interesting that he said that. I mean, I'm not surprised, but there's a couple of states that ban TikTok. But China has the data. They don't have the data based on this. It's 100% on Oracle's cloud. I forgot what he called it, like the safe cloud or that's perfectly fine, but it's transparent and everything. But again, we don't know that from what we read, right? Because we're reading what is controlled out there, and what's controlled is, holy shit, they're stealing all of my data, and this is the worst thing in the world. But let's see, because there's a lot of catch up these companies, social media companies who have gotten annihilated need to do because TikTok came out of nowhere, it's beating the crap out of them. Finally, really quick, I want to talk about Bitcoin. Holy shit. You wake up and, some people didn't pay attention yesterday because the markets were closed. Everything was closed Monday, Martin Luther King, but 21,000. Even Ethereum surging to over 1,500. It was 1,100 to begin the year. I will say this about crypto, someone that follows it a lot. The massive rally we're seeing, and this is like a 30% pop this year, right? So this is like in 17 days, less than 3 weeks. It's not coming from retail investors. And this isn't retail. Retail investors got annihilated, right? They got annihilated. A lot of these guys are taking their Ethereum and Bitcoin off of platforms, and it makes sense. Take them off of, after FTX, Celsius, Voyager, Gemini and Genesis now with that back and forth. And I think they're both being investigated, I'm pretty sure, by whatever, just to see their loan lending units, right? But to see them removed from the platforms doesn't mean that they're selling this stuff. They're putting it into cold storage. I mean, they're storing it offline. They're going to hold it. And if you're doing that, you're probably not going to trade it. You're not on a trading platform. You have it in cold storage and saying, okay, I'm going to be a long-term holder. I want to make sure it's safe. Here it is. Think of like a little USB device, much more different than that, of course, because you have all these passwords and these 16 passwords you have to put in and keep things offline so nobody could take them as long as you have them stored. And you have them on FTX. Next thing you know, everything's locked up and you're like, holy shit. And I know people who have a lot of money locked up, especially in Celsius, a lot of money locked up. And again, they went under and a judge just ruled that Celsius is allowed to keep those assets. Those are their assets. Imagine that. Imagine you have money on a platform, they go bankrupt and they say, okay, whatever it is, 4 or 5 billion, whatever it was. Well, there's $1.5 billion left and that's Celsius money. Imagine that shit. Oh my God. I mean, it makes you really want to take your money off all these platforms, which I think is what you're seeing with Silvergate. Silvergate's a name I like. I don't see any fraud at all. But however, if you're making a run on a bank and people are nervous and taking their money out, the stock's going to get destroyed. I mean, it's up tremendously now, right? On there's somebody shorts in it and people just, annihilate him saying it's fraud, it's fraud, it's fraud. I haven't seen any fraud. But if they had to sell $8 billion worth of securities, I haven't seen a company in crypto do this when it comes to selling. Usually when they have a big payment or they're like, wait a minute, they halt withdrawals or anything like that, which Silvergate didn't do. Silvergate had their money in treasuries and debt securities, and they had to sell some of those debt securities for a loss because $8 billion was removed. And they made that payment. They said, they sold a little bit at a loss in a debt. But they made that payment. They didn't say, oh my God, we got to claim. So, they're a publicly traded company that gets audited, that has to report quarterly financials, and they're under more scrutiny because they're a bank. So if money continued to come off that platform, I could see people getting nervous because they're like, holy shit, this could be the FTX. That's why you're going to see the stock crash. But in terms of fraud, I still haven't seen it. I haven't seen anything. People saying it, but I haven't seen it. I think it would have been reported by now. But it's interesting to see how, that's jumping. A lot of crypto names are jumping. But when it comes to retail investors who got annihilated, right? You're looking at Bitcoin, this pop in Bitcoin, it's $100 billion, almost $100 billion in market cap in 3 weeks. That's how much it's gone up, right? To over 400 billion in market cap. You don't see that move from retail investors. This is coming from institutions. And it's interesting to see if they're going to be able to maintain this rally, right? Because it came out of nowhere, right? And you're looking at some names in our crypto intelligence portfolio up 50% from their lows in 3 weeks. Granted, they're still down, right? We saw crypto get annihilated, right? This industry, a lot of industry leaders fell 80%, right? So even the shit coins, right, came down just as much. But to see the whole industry come down where you have high quality names, which we do have in our crypto intelligence portfolio, just as much as some of these shitcoins, is ridiculous. They don't have any utility features or anything. But now you're definitely seeing that, flight to quality after a huge, long, drawn out bear market, crypto winter, whatever you want to call it. And I'm not saying that this is for real or it's going to be, continue to go high or whatever, but this is a massive move that nobody was really predicting, right? Especially with FTX and money coming out of the market, and you're seeing, Coinbase and, even the good names, the Robinhoods and stuff like that, money being removed from the platforms with a little bit of concern and worry and putting it in cold storage. Again, they're not selling those cryptos, but they're just pulling it from that. It's kind of remarkable to see how much this has gone up. Again, we're looking at a 30% move in less than 3 weeks. But you don't see $100 billion move in market cap for an asset class or a stock or whatever. That's not retail investors. That's institutions. And a lot of institutions now are starting to offer Bitcoin in their 401ks, right? Which is interesting. But I want to see where this is coming from. But this isn't coming from somebody small. This is coming from someone very, very, very big in the industry. I'm going through my sources to see where it's coming from. Again, it's not retail investors who, a lot of these guys are broke, got annihilated in crypto and were on margin and shit, and especially had their money in some of these platforms, lending platforms that seize their assets. This is coming from institutions. And it's interesting to see this move and how it continues to go higher and higher and higher, especially given that this market crashed even before, right? It's been a long crypto winter, but it crashed even before the market started crashing, probably a quarter and a half before that. On a personal note, when I look at crypto, to see FTX go under, we're the biggest in the world, 16 billion, right? Valuation at its top. Genesis, Gemini looking wobbly here. I mean, and then you throw in everything that happened with the Celsius 3 arrows, just, massive blow up after blow up after blow up, just seeing the leverage come out of this market, massive leverage. To see Bitcoin and Ethereum holding strong through this massive uncertainty, it makes you think, how could it get worse than that? Like, if you're able to rally in the face of these massive headwinds, what happens when a lot of these bigger institutions start buying Bitcoin and Ethereum, which is probably happening right now? But think about all this. Is it going to get worse than what it's gotten with FTX? Is it going to get worse than that? You guys see Binance go under? No. They're going after Tether like they went after the past 2-3 years, and they were supposed to get audited financials. They didn't get audited financials. Are they back? Do they have everything covered in their stable coin? I get it. You're going to try to go after these guys and push this thing down. It's getting much harder to go after them when you see rallies like this, because now it's destroying the shorts. It's really killing the shorts. But to see everything that happened, and now you're seeing this move higher, could it be short covering? Yes, exactly. Of course it could be short covering. Just you're moving higher. But again, $100 billion move. This is a $100 billion move, right? This is huge. So is it the shorts covering? Maybe you could say shorts covering, but this, in order to force the shorts to cover, you have to push the stock higher. You have to push the Bitcoin higher. You have to push whatever higher, right? And you have to have some money coming in to almost force this, right? And then when you start forcing it goes higher, you see the shorts covering. That's called a short squeeze, right? So the shorts have to buy it back, and they continue to get annihilated because their risk, if they're not covered, is unlimited, because Bitcoin can go to 60,000, 10 million, 50 million, right? It can only go to zero on the downside. You can only lose the money you put in, but when you short, you have unlimited downside. It's very dangerous. So to see, yes, there is short covering there, but just to see this massive move in the face of all of these headwinds, I mean, I don't know if anything could be more positive than that, right? So it is interesting. You are seeing, more people hold Bitcoin than they've ever held. So you are seeing volatility come back into it, or a little bit more liquidity come back into the market. But overall, I mean, Bitcoin, to make this move, you got to be happy with it. Is really good. And it's, again, it's going up much, much higher than the markets. Even when the markets were coming down in December, it was still showing through December, it was still pretty strong. So it's interesting to see it decouple away from the markets and risk a little bit more. But let's see what happens in the coming weeks and the coming months. But it is definitely quite a bid, up tremendously, and I'm happy for our crypto intelligence subscribers, because that's the one portfolio obviously that's gotten annihilated after the average position. I'm not kidding here, guys. The average position in that portfolio, and I think we probably had like 17 positions, the average position was up 600%. So the risk reward is definitely worth it in crypto when you see the potential gains like that, and that's what you're still offering. That's where all the innovation is coming from within the markets. Yes, we know AI is out there. AI has been around. It's getting better and better. So at CES, you're looking at new chat GPT, you're looking at so many different, Microsoft announcing more AI programs. We're seeing it firsthand of how AI is really accelerating, right? It's amazing, but that's a trend that's been around for a while. It's getting better and better. When we talk about the innovation that's coming from ownership of your own content through, merging the physical world with the virtual world, which every major company talked about the CES when I was there last week, 2 weeks ago. Just DeFi. I mean, just the trends within this and how it disrupts just our traditional financial system is amazing. And it's coming, right? The internet is coming, a new internet where you own your own content. It's not owned by 4 or 5 people. This is where it's coming. This is where it's coming from. And there are going to be names that have the potential to go up much, much more than stocks, which is why we have a newsletter about this and we focus on it. It's been bad for 2021 like everybody else. We are having, obviously, a very good start to the year. A lot of our names, we own very good quality names in that portfolio. It shouldn't have been down as much as the shitcoins, but we're very happy about that portfolio right now. And hopefully it continues to go higher because 2021 was a tough, tough year. So that's it right now. I'm going to come back with Daniel and discuss everything, but you're looking at the markets, guys, we're going to be all over the place. You've seen a 4% rise this year already, yet you go into earnings season where earnings have been revised over 7% lower heading into this quarter since September. I've never seen a revision that big in over like a 3-month period heading into this quarter, into a quarter ever, other than if it's during black swan events like we saw during COVID and the credit crisis, right? Which nobody had a clue of how deep it was. Outside those events, I mean, this is a recession, which used to be typical. We were allowed to go into recessions. We weren't allowed to go into recessions for the past 12 years, but recessions are normal every 4 or 5 years. We weren't allowed to do that because of the Fed, kept interest rates super low because we didn't have a lot of inflation. It's different now. It's much, much different, right? It's different from past recessions since we have inflation still near 40-year highs that we're having trouble controlling. It's not going down as fast as we want. It's the first time since 2000 that the Fed is not going to be able to help us out of a recession by lowering rates and buying bonds, constant QE. We've always seen that for the past 12 years, 13 years. Okay. Any problem? Fine. We'll bail you out. Don't worry about it. No, you can't do that anymore. When you have inflation, you have too much money in the system. That's why they have QT. That's why they shrink in the balance sheet, right? So they're not buying bonds anymore. And you're not seeing them lower rates. They're not going to lower rates anytime soon. They may pause, but probably not till March, April, right? Which is consensus, probably even longer if the market continues to do okay, which is where I think most economists and analysts have it wrong. This is why I've been bearish. They're very optimistic that most of the damage has been done. Earnings are going to hold up. We're going to see a mild recession, right? That's a consensus right now. I don't see any evidence of that. We see the markets try to rebound like we're seeing now, but it opens the door to buy long-dated puts on so many names that are still trading astronomical valuations, given the macro backdrop of what? Higher rates, almost no international growth. Everyone's cheering China's coming back. Let me tell you something about COVID. It's almost like a new strand that I'm hearing that's going around with COVID. It's a much older population. People are afraid to go out. People are expecting this whole, new wave. There's bodies lining up. There's so many people dying because it affects older people, and it's an older population. It's very, very sad. I think it's very misguided where people are saying, oh, China's back and it's opening up. You don't just open up even when we opened up and people go out. You're still going to have most of the population, especially this older population, very, very scared. And this is what I hear from my contacts there. So be careful using that China as the catalyst of growth and oil and everything else. And I think oil is going to do well, regardless, but that could really, end up as a big catalyst with China coming back online. It's just going to take a lot more time to come back online than people are predicting and people are talking about in Davos right now. All right. So when I see these huge valuations and given, again, very little international growth, Fed constantly removing liquidity from the market, shrinking its balance sheet, we create a money flow trader for this environment, right? It's one of the products we have that was up 30% last year. Each position was up more than 100% annualized. I don't like using annualized, but in this portfolio we do because some of those gains come in a few months, right? 3 or 4 months. So if you're making 100% gains in 4 months or 30% gains in 4 months, you would annualize it for the whole year, because a lot of those gains have come based on stocks and you betting against stocks, again, long dated puts over, say, 2 quarters, 3 quarters, where they're going to miss earnings. They might go up a little bit, and you don't care if they go up 15% because we get a good CPI number, but that just with banks, you're going to see this constant drag on banks as they continue to raise their loan provisions, right, for those losses. As they continue to do that, it's going to be very, very hard, especially when you don't have any of that fee-related business. Are you seeing M&A? No. Are you seeing that? No, absolutely not. No M&A, no takeovers. Advisory fees are going to be down tremendously. It's going to continue. So when I look at banks or look at some of these other companies, even retailers, you're going to see them take a hit in earnings. And if you see a 20% decline, especially early on, these puts could go up, 1x, 2x, 3x right away. And not only are you protecting your portfolio, you can only lose the money that you put in, but you have a chance to make an absolute killing, massive gains, which we showed last year. Again, this is why I created the product. I was a little early on it. My apologies, because I knew the market can't continue to rally. So I created, I think in 2017, 18, when earnings started to peak, and they peaked in 2018. They went down from 2018 to 2019. So the end of 2019 was when COVID started. And then we had this massive collapse because China shut down, everything shut down, COVID went crazy. And then we had this massive flood of money, which pushed the markets even higher. Now we're taking that away. This is one of the greatest strategies and easy strategies that you can learn. So we have an offer for you for Money Flow Trader. It's very easy to get. You can go to mftoffer.com. We have it for 90% off if you're interested. If not, please learn how to buy long-dated puts. Because even if you're wrong, your long positions are going to do okay. It's fine. Again, you're only going to lose the money you put in. But please learn the strategy because the volatility you're going to see, especially this year, demand's going to continue to fall off a cliff. And I feel like nobody's talking about that. Like it's suddenly going to get better. It's not going to suddenly get better. Even if the Fed decides to lower rates, we saw how long it takes even when they raise rates at the fastest amount they've raised in history of how we still have inflation very, very, very high. It's going the right direction. But we see how long it takes. It could take years, many, many years. In 2000, 2001, so 2001, we really started lowering rates. In 2002, 2003, we had a 3-year collapse in the markets before we saw them bottom out, right? So I expect us to hit the lows again, especially in the NASDAQ and technology over the next couple of months. And you can make a lot of money with the strategy. And if I'm wrong, you're still going to be long your positions that you're long in long term. And you'll do very, very well. But this is a way to not just protect yourself, but make an absolute killing as these guys struggle for profits. They're going to go more rounds of layoffs. They're not going to see demand on their top line. They're not going to have pricing power anymore. They're just not, with prices coming down and inflation coming down. They are seeing their costs come down, a little bit, which is good, but still demand is not there. And this is your chance to really, I say it, put your middle finger up to Wall Street. All the time they beat you. This is a time to bet against them. An easy way to do it to MFT, Money Flow Trader. You could do that. Again, it's 90% off if you're interested at mftoffer.com. If not, no worries. Please learn how to buy puts because I care about you guys and I want to see you guys make money in one of the most difficult conditions that we're going to see. And for the first time in about 20 years, or well over 20 years, we're not going to have any Fed help. The Fed is not going to be there for us. They're not going to lower rates. They're not going to bail out. They can't because inflation is still out of control. And they can't lower rates. They can't just continue to spend money. This is for the first time. They've been doing that for a very, very long time. They can't do it. And I don't think that's factored into earnings or factored into this mild recession that most economists are predicting. So, guys, that's it for me. I want to say go Jags. Holy cow, what a game. The team spirit here. I mean, you see with Giant fans, stuff like that, but even the kids, like our kids go to school, they all make them wear on Friday, jerseys and stuff like that, anything, Jags, and just to see that game, I don't know if you guys know, it's 35 degrees on Saturday, which is when it's 35 degrees, that's like 35 below here. Like people wear scarves when it's 50 here and earmuffs and stuff like that. It's pretty funny when you see it 55. I'm always wearing shorts. But just, again, in Florida, it's different. It was 35 degrees. That first half was the worst first half you're going to see. 4 interceptions from Lawrence. It was just a disaster. But for him to come back, and a lot of those fans that stayed there during that game, that was awesome. That was really awesome. Just to see everyone going crazy here, it's really cool. And if I was the Chiefs, I'd be worried. Playing that team right now after that amazing comeback, I'd be worried. So it should be good games next week for playoffs. Anyway, questions, comments, I'm here for you. Feel free to email Frank at CurzioResearch.com. That's Frank at CurzioResearch.com. I'll see you guys tomorrow. Take care.